As I mentioned in my previous video, there are literally millions of trading strategies, but once we pick one, how do we know that it works? One word: backtesting. Well, maybe it's 2 words. This is exactly how to backtest manually, the right way. This is the best way to backtest your trading strategy manually. This is a step-by-step process I'm going to take you guys through. So step 1, you want to define non-negotiable rules. This means that these are your rules and they never change. So before touching the chart, write down the rules that leave 0 room for guessing. So this includes rules like context and bias, what market condition must be present, for example, higher time frame trend, specific session, liquidity sweep, things like that. Your entry trigger, so your exact candle behavior or pattern that you look to find your entry. This could be a 5-minute fair value gap, or for example, a 15-minute engulfing candle. Then you want to define your risk and invalidation. So this is where you have your fixed stop loss placement, whether this would be at a swing high or somewhere else. So basically how much you're risking and where your setup is invalidated. Then you want to have your exit strategy, because you can have an entry strategy, but you need to know where to exit. So this is where your take profit would be. For example, you could have a fixed take profit at 2 risk to reward, 1 to 2, or your take profit could be at your next liquidity level, or you have just a trailing stop. So step number 2, set a solid sample size. So this is actually very important, because some other people say, like, oh, just backtest 30 trades and you're fine. That's not exactly true, and this is the reason why. So first off, you obviously want to select 1 to 2 assets. You never really want to trade more than 1 to 2 assets at a time. Focus on the pairs that you're actually going to trade. All the other pairs really do not matter, unless you want to go ahead and backtest all of those. That will take forever, but usually 1 to 2 is fine, because you're not going to be trading a bunch of pairs regardless. So then you want to frame your samples. Amount of your sample size differs, because it depends on if you're trading scalping or intraday or swing trading. That will make the sample size different. So if you're trading intraday, for example, if you're using like the 1 minute through the 15-minute time frames, if you test like 3 to 6 months, which I would say at least 6 months, you're probably going to be testing a few hundred trades just in that 6-month time frame. But if you're using the higher time frames, for example, the 1 hour, you might get like 100, 200 trades, and that will be over the course of a few years. So it depends on the strategy that you're using, the time frames that you are using. So you want to aim for a minimum sample size of 100 trades, but to really get the better statistically reliable numbers, I would say 500 to 1,000 is better, or just as much as you can. The more data that you have on your strategy, the better idea you have on its win rate and all those individual statistics. So step number 3, you want to use market replay to your advantage. So obviously you want to scroll back using market replay to whatever starting date you want to start testing your strategy, and you want to use the bar replay tool. So then you go forward, obviously candle by candle, and this is the thing that a lot of people don't do. What you should do is you want to take every setup. If the setup fits your strategy, take it. This gives you the most amount of data that you can get. And this is another thing: if your setup matches your plan, you have to log it, even if you feel it will lose, because you do not want to skip trades in hindsight, because that artificially inflates your win rate. You want to have the most statistically reliable data that you can have on your strategy. You don't want to cut corners or anything like that. So this is why. And also a quick tip: you can pay for TradingView Premium to get the bar replay tool and to go all the way back and get all that historical data. Or if you want to do it for free, which is what I do, because why not just do it for free? There's a website called Beaveron, and it is a free strategy backtester, and it also journals your trades. It's not as good as TradingView, but it does work. And for example, here, this is what it looks like: beaveron.com. You can have active sessions, bar replay, multiple time frames, historical data, and then this is the journaling side of it. You can see it logs every single replay session, all the trades, the win rate, the average risk to reward, all of that. So it does all of that for you. Now this goes kind of with step 3. Step 4 is track all your data. You want to track all your data, all your statistics, so you know all the ins and outs of the strategy and how it performed. So this is why Beaveron is clutch. It tracks all your data and statistics for you, so you don't have to individually track it. When you go to bar replay, you start a trading session, it tracks all of that for you in the journal side of it. So it's really cool and it's amazing. It's a great free tool if you want to save you time and money. So step number 5, you want to calculate the metrics. Once again, Beaveron does this for you for free. I'm not sponsored or anything. I just really like the platform because it works and it journals everything for you, which is amazing. It saves you a lot of time. So obviously once your sample run is done, you want to compute your baseline stats. So these are stats like your win rate, average risk to reward, your expectancy, max consecutive losses, and drawdown. That matters mostly, I would say, for prop firm trading. Obviously you don't want a lot of max consecutive losses and a lot of drawdown either way. However, that's mainly the worry on actual funded accounts. So the golden rule of manual backtesting, and this is something, once again, that I touched on a little bit earlier, you do not tweak your strategy mid-test. You have your specific strategy set out and your non-negotiable rules beforehand, and you stay with that the whole entire backtest. You don't want to artificially inflate any of your results. You don't want to change anything because then it's not going to be statistically reliable. If you notice a pattern during the test, write it down as a note. Finish the full run with your original rules first, then adjust and retest on a fresh set of historical data. Now this is the 5-step process to manually backtesting your strategy the correct way, the best way, the right way. You want to follow these 5 steps. And remember, you can use this platform if you don't have the money for TradingView. And I don't know if TradingView tracks all of this data, but it is all tracked on beaveron.com. For example, I will show you guys a trading journal here. This backtest I was just testing out something, so don't really pay attention to this. But as you can see, I backtested multiple trading sessions. It looks like, I think 11 total. And if we just click on, I'll just click on this one. This was a strategy using my trading strategy just with 1 time frame, not using 2 time frames. It did pretty decent. So you can see it shows you the net P&L, shows you the balance, the win rate, the expectancy, profit factor, payoff ratio, planned RR, largest win, largest loss. It has a performance factor where it grades your performance, recovery, sharp, max drawdown. It literally shows you every single statistic that you would need to know. And that's just the overview. Then you can go in the analytics and it breaks all these extra things down. You get all the information that you need to know. Hope you guys enjoyed this video, and I'll see you all in the next one.